So you're watching this video if you want to learn how you can improve your credit score, or if you have good credit and you want to learn how you can keep your good credit, or if you don't even know what credit is in the first place. Let's jump into it. So your credit score in a nutshell is a report card that lets lenders know how good you are at taking on and repaying debt on time. Your credit score determines whether they'll be giving you money, no money, or money with a related interest rate. An interest rate is a percentage on how much interest or money you're going to be paying while the loan is taken out. Interest is money paid regularly for the use of money being lent. So if I let you borrow $100 with a 5% interest rate, I'd expect you to pay me $5 per month until that full $100 is paid back. The interest is separate from the money you owe me. I still need the $100. And a good credit score will usually allow lenders to give you smaller interest rates, so you'll be paying less money over time when you borrow money. And a good credit score can save you tens of thousands of dollars over years when you're paying a mortgage. So where can you find interest rates? Mortgages, car payments, student loans, personal loans, business loans, and yes, especially credit cards. And why do I say especially credit cards? Because credit cards usually have really high interest rates. Compared to a mortgage with the usual 2 to 5% interest rate per month, with a credit card, you're probably going to be paying 15 to 25%. So why would you even want to use a credit card if you're going to be spending that much on interest in the first place? Because you only pay that interest if you don't pay the card off every month in full. That's right, banks are banking, pun intended, on people to overspend and rack up debt on their credit card that they can't pay back each month, and thus they'll have to pay that interest. In fact, according to creditcards.com, the amount of American households with outstanding debt each month on their credit card was 37% in 2019. So if you don't have to pay interest on your credit card if you pay it off each month, why not just use a debit card or cash? I'll tell you why. Because when you use your credit card, the bank actually pays you in the form of rewards. Lots of cards will usually give you 1 to 2% back on purchases each month, some even higher, like 3%. And a lot of cards offer really cool things like airport lounge access, airline upgrades, airline miles, hotel upgrades, gift cards, just a lot of free stuff. So it's kind of like you're getting paid to shop. Well, be careful. Remember how I was saying that a lot of people end up in credit card debt that they can't pay back each month, and so they're paying interest? I'm going to tell you how to avoid that. Don't buy anything you would not normally buy. Do not buy anything you would not normally buy. Do not buy anything you would not normally buy. If you have $100 in cash and a credit card with a $3,000 limit, do you really think you should buy a $3,000 computer? No, instead you want to use your credit card for things like gas, groceries, night out with friends, stuff that you would usually buy if you only had cash. And then use the cash that you would normally spend to pay off your credit card each month, and then boom, you have no debt, you pay no interest, and you get rewards every month. Well, how do you actually start building your credit? Well, credit is dependent on 5 key factors: your payment history, credit card utilization, average age of your credit, derogatory marks, total number of accounts, and hard inquiries. First is your payment history, the most important. Do you pay your credit card, loans, bills, rent, all that stuff every month? This is huge for your credit score. It's actually absolutely the bare minimum you can do to have a good credit score. You want to make sure all your bills are paid on time. You want to make sure your credit card is paid every month on time and in full. That means at the beginning of the month, or whenever your statement resets, you want to have that account number at 0. Now, let's say you have a lot of credit card debt that you racked up and you can't get it to 0 by the end of this month. That is what the minimum payment is for. The minimum payment is the payment you can make on your credit card every month without getting a late payment. It's usually like $25. Now, here's the thing about the minimum payment. Usually, the minimum payment is less than the interest you're paying. So if you're only paying the minimum, you're not exactly going to be paying off that debt. You're just going to be, again, giving money away for free. So you always want to pay more than the minimum payment. If you can, like as much as you can. If your minimum payment is $25, try throwing $100 a month at it. And if you look at your credit card statement, there's usually a section that says if you pay the minimum amount, this is how long it'll take you to reach 0. And a lot of times it says it'll take years. The banks try to make it okay to pay the minimum amount, but you don't want to do that. They have an incentive to to keep you in debt so that you'll continue paying those high interest rates for years. So always pay as much as you can and try to get that down to zero ASAP. If you get it down to zero, they can't charge you anything. Also, I want to notice you want to get it down to zero right before your statement resets. It's not always the first of the month. Mine is the 20th. In fact, I usually do it a day or 2 days before. And missing one payment can be detrimental to your score. So make sure you get those payments down to zero every month to get that score up and keep it up. And in fact, if you haven't had credit for that long and your credit score is not that great, getting your credit card balance down to zero will drastically improve your score in just a few months. 2. Credit card utilization. Credit card utilization is the amount of debt you have across all the accounts you have open. As a rule of thumb, you want to keep this below 10%. Some people will tell you 30%, but they must not have very good credit. So let's say I have 2 cards, each with the $5,000 limit. That would mean that my total credit limit is $10,000. So using 10% will only allow me to use $1,000 of that $10,000 each month and paying it back every month in full, of course. So why does this even matter? Why shouldn't you be able to use the full $10,000 if the full $10,000 is available to you? Well, lenders don't really want to lend money to a person that is using all of the money they have available to them, if that makes sense. Would you want to lend money to someone that always seems like they're strapped for cash, or someone that has a lot of money available to them and only uses a little bit of it when they need it? The less you use each month, the better your credit score will be. If you have multiple cards, I would pay off all of them and use one as your primary card, probably the one that offers you the highest benefits. But do not ever close the cards you are not using. I'll tell you why in a little bit. Number 3, derogatory marks. So what happens if you miss a payment on your bill, loan, or credit card payment? Well, 30 days after it's late, your bank will notify the credit bureau and you'll get a ding on your score. 30 days? Yeah. So let's say you're 3 days late on your credit card payment, you're going to be paying some interest and your bank is definitely going to notify you, but they won't notify the credit bureau until 30 days after. So even if you're a couple days late, you really want to make sure you get that paid ASAP. With unpaid loans or bills, your debt gets sold to something called a collection agency. Let's say you haven't paid your cable bill, the cable company's been contacting you, they haven't heard from you, and they just want to get rid of this debt. They're going to sell it to the collection agency, and the collection agency is going to tell the credit bureau, yo, this guy did not pay his bill. The credit bureau will put a derogatory mark on your credit report, and that can stay on your credit report for up to 7 years. Now, there are some ways to get rid of them. I actually just called the collection agency once and was able to pay it, and the derogatory mark was taken off. I've heard that it doesn't always work, so you should just try your best to avoid that whole situation as much as you can. The average age of your credit history. Lenders prefer borrowers that have had credit for a while because they tend to be more mature, they tend to pay back more responsibly, and they also prefer people that have a mix of different kinds of credit. So credit cards, loans, car loans, business loans, personal loans, as long as they're paying all that back responsibly, that's really good. Usually having credit for more than an average of 6 years looks pretty good. Well, what do they mean by average age? Average age is the average age of each individual credit card or loan combined. If you have one credit card for 4 years and then you get another credit card, your average age will drop from 4 years to 2 years, and this will temporarily drop your score. Now, this sounds bad, but I'm going to tell you why getting multiple cards will actually end up helping you. The next thing that impacts your score is the total number of accounts that you have. The more lines of credit that you have open, the more responsible you appear to lenders if you're paying them off. Lenders love to see a mix of credit cards, personal loans, business loans, car loans. As long as you're paying them all off, you're probably a good borrower. So the more credit you have open, the better your credit score, which is why you never, ever want to close a credit card, even if you're not using it. The average age of your credit history starts with your oldest card or loan, so you definitely want to keep that open as well as the rest of them. Usually more than 8 lines of some form of credit look really good. For all the cards you're not using anymore, just put them away somewhere. Unless there's an annual fee for the card or there's a revolving payment on the card you forgot about, you're not going to be charged anymore. Now, some cards require you to make at least one purchase a year, so I don't know, maybe buy some stickers or something like on your credit card once a year. If you heard that if you open a new card, your score drops, that is true, and I'll tell you why. I know everything sounds contradictory. If you open a new card, your score drops. If you don't have a lot of open accounts, that's not good. If you close accounts, that's bad. Yeah, but it's like it all relates. it gets easier the more you practice. The next thing that impacts your credit score is a hard inquiry. A hard inquiry is when a bank or a lender checks your credit for something really, really important or big, like a mortgage, a car payment, a student loan, or a new credit card. These are called hard credit checks, hard credit pulls, or hard inquiries. Now, the reason that these hurt your credit score is because it doesn't look so great if you're the kind of person that's running around town looking for a bunch of money. You remember back to when I was talking about credit card utilization? You want to make it look like you don't need the money. Hard credit checks don't affect your credit report that much. But they do, especially if your credit is young and super volatile. They usually stay in your credit report for about 2 years, which is why I usually only apply for a new credit card about once a year. And you definitely don't want to apply to a credit card you know you're going to get denied for, because then you have a hard inquiry on your account. And for what? Now, if you're running from bank to bank, making hard inquiries on your credit for the same kind of loan, like a mortgage, then the credit bureau is only going to count that as one hard inquiry, because they really encourage people to shop around for the best rates that they can get. There's also something called a soft credit check, which doesn't hurt your score. This could be for something like checking your credit score in your banking app, or credit cards pre-approving you. Also, checking your own credit score in your banking app does not hurt your score, contrary to popular belief. So that's everything you pretty much need to know about what will affect your credit. 1 is your payment history. You want to make sure you pay that every month. 2 is your credit card utilization. Keep that under 10%. Number 3, derogatory marks. 4 is the average age of your credit history. Lenders prefer mature credit. The next thing that impacts your score is the total number of accounts that you have. The more the better, and remember to never close your accounts. The next thing that impacts your credit score is a hard inquiry. Remember, they stay on your credit report for up to 7 years. So don't go crazy applying for credit cards. The app I use to check my credit score usually is called Credit Karma. This is not a promoted video. They just have a really good credit checking tool. They show you both the credit bureaus. They show you what is affecting your score. They show you what you can do to improve it, and it actually updates every day as opposed to the Wells Fargo app, which updates like once a month. So I definitely keep track on both. So yeah, now if you have any questions, let me know in the comments, and get that credit score up, guys. Pay those bills. Have a good one.